What if I told you you could become a millionaire for the price of a daily cup of coffee? You'd probably assume I'm trying to sell you something and click off the video. So before you do that, I'm not trying to sell you anything. I don't have a get-rich-quick course or anything like that. Instead, I'm going to walk you through how you can become a millionaire for the price of a cup of coffee using resources and tools that are publicly available on the internet. So if you want, after this video, you can go back and fact-check everything that I said. So becoming a millionaire for the price of your daily cup of coffee. Now that sounds pretty far-fetched, so let's break it down a little bit. First of all, what is a millionaire? Well, simply put, a millionaire is anybody who has a net worth of at least $1 million. This means that their assets minus their liabilities is $1 million. Let's next assume that your daily cup of coffee comes from a coffee shop. We can use Starbucks as an example because, let's face it, they are everywhere. Now, let's say that you don't get the cheapest cup of coffee available at Starbucks, but you also don't get some crazy super grande venti vanilla iced caramel American macchiato drink. Instead, you get some kind of middle-of-the-road cost drink. So since you're getting a coffee that's of mid-range price, let's say that it costs you $5.20 per cup of coffee. Let's also assume that if you were to instead make this coffee at home, it would cost you around 20 cents for an iced coffee. This means that if you were to make the coffee at home instead of going to a coffee shop, you would save $5 per cup of coffee. Finally, let's assume that you took that $5 you saved and invested it in an investing app like Robinhood or Acorns. Now, if you took this $5 that you saved every single day and invested it in the stock market for 46 years, and you got around a 9% return on your investment every single year, without any outside investments, without any kind of complicated stock options, without doing anything except leaving it in a passive index fund, you would be a millionaire. Now, if you were to invest the same amount and instead of getting 9% per year, you got 12% per year, you would become a millionaire in only 38 years, and after 46 years, you would have $2.7 million. Finally, even if you didn't get 9% per year and you only averaged 7%, you would still become a millionaire after only 55 years. In order to understand how this math works, all you have to understand is the idea of compound interest. Now, with compound interest, there are two key factors: time and interest rate. Now, time is the easiest to control. Now, since I'm still in my early 20s, I can use time to my advantage since I have a long time over which I can invest. Now, while I'm still young, I basically try to save everything I possibly can so that I can invest as much as humanly possible. And there are also other advantages to saving while you're young, like, for example, the fact that I don't have to take care of a family, so I can save a lot more money. Also, the fact that I can live with roommates while I'm still younger and it's still socially acceptable allows me to get a cheaper place to live. There are so many advantages to just investing while you're young that you won't be able to take advantage of as you get older. Now, the second key factor is interest rate. Now, basically, anytime you invest in something, in exchange for you loaning someone your money, you can expect to receive in return interest. Now, there are literally thousands of books written on how to get more and more interest, but basically the baseline, if you were to just invest in the stock market and not do any work whatsoever, you would get around 9% on average per year over a really long time horizon. Now, if you want to get a better interest rate than this, most agree that the only way to do this is to take on more risk. Now, whether that's through active stock trading in a specific niche that you know really well, or maybe getting involved in real estate investing or starting your own business. All of these are ways to get interest rates far above 9%, which you can take advantage of if you just have the time and you're willing to take on the risk. Now, there are a lot of people out there who really don't believe that it's possible to earn much more than a 9% return per year. But what if I told you I could increase your returns by 25% every single year without really requiring any effort from you? Well, the key to doing this is simply to use tax-advantaged retirement accounts, which are either an IRA or a 401k. Normally, when you invest in something, you actually have to pay taxes on that money twice. You have to pay taxes when you first earn the money, and then you also have to pay taxes if you make any returns on your investment. Anything above what you initially put in is taxable by the government, unless you use a tax-advantaged account. One great way to do this is to put $6,000 every single year into a Roth IRA. What this means is you pay the taxes up front when you earn the income, but later on down the line, after you've built up that initial investment to many times what you had originally, you can pull all of that money out tax-free after the age of 59 and a half. Now, effectively, since you're not paying taxes on this gives you an advantage from anywhere to 25 to a 50% return on investment, depending on what your tax bracket is. Now, sure, you might say most people are probably not going to fund their entire retirement using the money that they would have spent on a cup of coffee, but the idea still makes sense. Small purchases that you might not even think about really add up, and if invested consistently over a long time period, could actually make you a ton of money and make you massively wealthier. Which kind of leads to the third important part of investing, which is consistency. Now, this strategy basically involves you consistently putting money into the market and then leaving it for a long period of time. If you can just invest consistently over a long time period while making a good interest rate, it suddenly becomes very difficult for you not to become wealthy over the long haul. Now, if you want to invest for yourself, there are a couple good apps out there that you could use. You could use Robinhood, you could use Webull, Acorns is a good one. And then if you want to set up a Roth IRA account, I would recommend using either Vanguard or Charles Schwab. Vanguard is good because it has a lot of options for low-cost index funds, and Charles Schwab is nice because it offers commission-free trades. I'll provide links for all of these down in the description. The next obvious question that someone would have at this point is, what should I actually invest in? Now, all I can really tell you is what I would do, and this is what I would tell my friends and family if they were to ask me. Unless you really know what you are doing, I would not invest in individual stocks, and I especially would not do options trading. I'm looking at you, Wall Street Bets. Instead, I would just invest in a broad market index fund or a fund that tracks the general market. A couple good ones are VT Sachs at Vanguard or the VTI ETF. This will help you reduce the risk in your portfolio because as long as you have a long enough term investment horizon, you'll average about what these indexes have averaged in the past, which is 9% per year over a long enough time horizon. As long as you leave your money in through the ups and through the downs, in the long run, you'll turn out okay. One of the main reasons that I choose to go this route is because of a bet that Warren Buffett made in 2008 with a bunch of well-educated elite hedge fund managers. Warren Buffett basically bet that a basket of these hedge fund managers' funds couldn't actually beat just the regular S&P 500 no matter how hard they tried. The bet was for a 10-year period, and Warren Buffett even put up a $1 million prize if any of the hedge fund managers could actually beat him. Not surprisingly, Warren Buffett ended up winning the bet, with the S&P 500 averaging up 85.4%, with the hedge funds only averaging 22%. When you factor in the costs associated with active investing, such as paying higher taxes and paying management fees, most studies have shown that you will actually underperform the broader market by trying to invest actively with a hedge fund or a mutual fund. When you see how putting in all the time and effort to actually invest in individual companies can actually result in you earning even less money than just taking the lazy route and letting it passively invest, it becomes kind of a no-brainer to just put your money into an index fund and let it sit for a long period of time. After all, you end up making more money this way anyway. To conclude, as long as you can maintain consistent investments, even small amounts of money when invested over a long period of time with a good amount of consistency can make you a ton of money. So the next time you take out a $20 subscription or maybe a car loan, think about how much that is actually costing you in the long run. I see people take out $500 car loans all the time, and to me, that just translates to millions of dollars in lost potential future earnings. In fact, just for fun, I looked at how much money a $500 a month investment for 46 years at 9% would result in. And it's almost $3.5 million. I really hope that Jeep Grand Cherokee is worth it. By breaking out of the consumer mindset and instead focusing on investing, I truly believe that all of us can achieve financial independence where we actually build up enough wealth that we don't have to work our 9-to-5 jobs and can instead just live off the income from our investments. With that said, I hope you enjoyed this video. If you did, leave a like, and then subscribe if you want to see more similar videos like this in the future. I'll see you later.